I think there's going to be a continued very healthy IPO market. The first day gains this year averaged 26%, the highest number since 2000. And then with the rising stock market, the aftermarket performance has been good as well. So I expect the second half to be very strong.
Paul, what are you expecting for the second half? We have some very big anticipated names. WeWork, of course, comes to mind, but sort of running into some stumbling blocks lately. Their latest private market valuation, $47 billion, but some of the big mutual funds valuing them at nearly half that. So what are you expecting? Could that throw off the IPO landscape at all?
Well, I think I would generally agree with Mr. IPO here with a little bit of a caveat. So one of the things that we've seen happen really recently, really only the last 3 or 4 years, are many large pools of capital entering the private markets very, very late and creating these vehicles where they come in and put $500 million, $1 billion, even more in these direct investments in very late-stage private companies. I think at the time that was happening, maybe a lot of people weren't as focused on the risk of that. Now that when you get to the public market, that's when the actual pricing occurs and the expectation of value occurs around the company. So I think you're going to see some people that are going to have some puts and calls around this that have entered very late in the process. But if you look at Foundation Capital, we're an early stage investor. 70% of the time we're first money in. We absolutely love times like this because it's a great time to be able to exit some terrific companies that have been incubating for quite some time before going out into the public market.
Yeah, Paul, when I hear you talk about that, of course, I think about the Vision Fund, given their proclivity to invest large amounts late in the process. At the same time, they haven't done so badly. I mean, we'll see what happens with WeWork, of course, but on Uber, they at least came in at a somewhat lower valuation than where the stock currently is trading.
Yeah, I think that's fine. It's just part of the things you have to look at is you have to look maybe a layer below that. Some of these players that have come in with these very large pools of capital without identifying anybody specifically are also very deeply leveraged in some of these investments. So when you look at some of these investments, not only are they coming in with large pools of equity capital and writing big checks, but they're coming in with large pools of debt, and that debt requires service. So I think you're going to see some negative surprises in that arena over the next year or two. But I think I'd go back to the original premise here, which is that are we in a healthy IPO market today? We absolutely are. There are a ton of companies that are in inventory that have been building up and building scale, nothing like we've seen, say, 20 years ago in the last really terrific IPO market. So these are much more significant, mature companies. I look at a company like a Zoom, for example. This is a company that I did the calculation in my head. I'm doing a big European trip. I'm talking to you from Paris today. So 37 meetings in 21 days, and I will probably be on Zoom more than I'll be on my MacBook during that time period. Now, that's a company that went public about 7 or 8 weeks ago. That's a sign of what's happening now. More mature companies coming out. They're more like early-stage public companies than they are like startups of the old days.
Jay, I think that highlights a really key point, and that is when it comes to something like valuation, how do investors quantify a company like Zoom or Beyond Meat, for example, where there's this societal impact that may be much more longer term, even if they're not turning a profit? Zoom, I know, is, but.
Jay?
For companies like Zoom and others that have a lot of upside potential, there's going to be a lot of volatility because the assumptions can change. But what has led investors to give very high valuations to some of them is that there have been a lot of technology companies that have gone on to enormous success, where they've got some fixed costs but relatively low marginal costs, and consequently large future profits are potentially there. And I think that's one of the reasons why Airbnb has such a high valuation. And I expect it will get a high valuation when it does go public. But on the other hand, a company like the We company with WeWork, they've got very high marginal costs, and there a high valuation is harder to justify.
Jay, I'm hearing a lot of optimism here, and Kathleen Smith at Renaissance, who we talked to about IPOs a lot as well, she said any private company that is not proceeding to go public in this market should have their head examined. But what are the risks here? Are there certain companies that should not be considering IPOs in this environment?
Well, it continues to be the case that young companies are waiting to grow a bit. And a lot of young tech companies are never going to go public. It's not a matter of waiting. It's a question of when they sell out to a big tech company in a trade sale.